Hi folks, and welcome to the Meaningful Money Podcast. This is season 17, episode 10. This is the podcast dedicated to helping you put your finances in order. My name is Pete Matthew, and I'm going to share with you everything you need to know and everything you need to do to secure your financial future. I'm here to help you make sense of money. Here we go. Once again, great to have you with me. Thank you so much for joining me. Now, last week, we covered the basics of legacy planning, including a pretty high-level overview of how wills work, inheritance tax, and stuff like that. But the main point of it was that estate planning, legacy planning, starts with you and whatever you want to happen. Only once we've established that can we then talk about how to navigate the system and to make it happen. And that's what we're going to try and cover today. So after the main body of the show, as usual, I'll read a couple of reviews that have been left and announce what we're going to be talking about next week. But before any of that, as ever, this podcast continues to be brought to you with the help of my friends at Seven Investment Management. They've been helping me out here on Meaningful Money for donkey's years now, coming up 10 years next spring. How amazing is that? So I'm super grateful to them for doing that. Please check out what they're up to. They're at 7im.co.uk. That's the number 7im.co.uk. This podcast is also brought to you by Meaningful Academy, which is the best place to learn how to take control of your finances, whether you're just starting out or whether you're a serious wealth builder. Everything you need to know about that is at meaningfulacademy.com. Okay, so last week we wrote down some thoughts about what we wanted to happen with our wealth, both before and after we pass away. We let ourselves dream a bit and perhaps think bigger than we might otherwise have done. And now we need to learn to navigate the system to make those dreams a reality. Worth mentioning, this is a massive subject, okay? So I've done my best, but I'm bound to have missed something. So hope that you get some value from it. Remember, notes and links from today's show are at the show notes, which is the only link you need to remember if you're unable to write this down for whatever reason. Just remember meaningfulmoney.tv/RP10 for retirement planning episode 10. Okay, right. With that in mind, let's have a look at everything you need to know first. Okay. Right off the bat, it's crucial to understand that anything you do, anything you arrange can be challenged. Anybody who feels like they might have a legitimate claim on your estate can go to court and challenge your will. Now, I don't know about you, but my mind kind of goes to those Agatha Christie type dramas, you know, with the family and they all hate each other's guts and they gather for the reading of the will, and then there's a massive shock because the old geezer leaves his wealth to his cat or something like that, or his Lithuanian housekeeper or whatever, and then everybody starts killing each other because they've all got motive. Now, in reality, of course, that doesn't happen. I hope not, anyway. But nothing has the power to tear families apart more than greed over the wealth of a deceased patriarch or matriarch. Now, don't let me worry you, right? I'm sure your family will be very civilized. They all love each other and they'll all get on just fine. But you need to know that anything you plan, anything you implement is open potentially to challenge. And that's all the more reason to be clear with your wishes and to try to set things up as unequivocally as possible. So just be aware, anything you do can be challenged. Secondly, transparency is usually the best option. Okay, another way to reduce the chance of misinterpretation after you've gone is to be clear about your plans while you're still here. So communication is almost always the best option as you make your legacy plans. Speak with the family members involved. Let them know what you're planning. Now, I appreciate that might not be easy. It's a delicate subject, to say the least. And there may be occasions where it will help you actually to keep the peace in the present by being a bit more circumspect about it. But remember, if you avoid addressing these things now, all you're doing is kicking the can down the road until after you've gone. And maybe that's exactly what you want to do. I'll no longer be around so they can squabble as much as they want then. But I guess it's each to their own, and every family is different. But if you can communicate your plans clearly while you're alive, it will definitely help to reduce confusion and squabbling after you've gone. Now, thirdly, trusts. Now, trusts are useful, but they require compromise. Trusts, I think, perhaps the most misunderstood mechanism I've ever had to deal with in my career. And I don't actually just mean misunderstood by clients. I mean by advisors as well, which is a little bit scary. But I do remember being very confused by the whole idea of trust when I was a green advisor some 20 odd years ago. Now, I did 3 consecutive 5-Minute Friday videos explaining how trusts work, so I'll make sure those are linked in the show notes so that you can watch or listen to those rather than just repeating it all here. But essentially, you can think of a trust as a box. Now, you are the settler, the one setting up the trust. That's settler, O-R on the end. Your trustees look after the box, and they make sure that they carry out your wishes. They're also the legal owners of the box, and that has some implications for them potentially. Your beneficiaries are the ones who get whatever is in the box, whenever you say that they can. Now, a trust is a legal entity in its own right. It's got its own tax rates and regulations attached to it. When I say that trusts require compromise, I mean it. You can't expect to get the benefits of using trusts in your planning without giving something up in return. So, for example, let's say you've got a buy-to-let property and you'd like to put that property into trust, maybe leave it to your grandchildren. Well, that's no problem. It's your property. You can do what you want with it. But you wouldn't be able to keep enjoying the rent. You can't give away the property into a trust and keep enjoying the rent from it. And the transfer into a trust would be a capital gains taxable event. And the gift may also end up being charged to inheritance tax, depending on the kind of trust. You might pay an inheritance charge at that point, or maybe at some point in the future. So trusts are not a sort of magic bullet. You just sort of open the box, put some stuff in it, and write on the box what you want to happen. They are very useful, but you can't get away from the fact that putting anything into trust, whether it's property or investments or money or whatever, it means that you're giving it away. You don't own it anymore, and you need to think through the implications of that. Remember, your needs always come first when estate planning. Remember that from last week. Your needs come first, more important than anything. Okay, so with those words ringing in your ears, let's just attempt to get a little bit practical and look at what you need to do now. Cracking on, actually. We're only 7 minutes in. It's funny, sometimes, you write roughly the same number of words each week. Sometimes you just power through them, and sometimes you don't. Okay, first thing you need to do is to decide whether your wishes, what you want to happen, are fixed or flexible. Now, if you're thinking of getting fancy with your legacy planning, perhaps using trusts or whatever, you're going to need to think through what might happen if circumstances change. So here's a classic example of this. Let's say you've got an investment property and you want to give it to your daughter. Well, you could just sign it over to her, right? It becomes hers from that point. There'll be some tax implications for you, most likely, but other than that, it's a fairly straightforward transaction, right? You just give her the property. But when thinking through the implications, you might remember that actually relations have been a bit strained between your daughter and her husband recently. What if they end up divorcing? Well, the property that you've given to your daughter is now fair game in any divorce settlement because it's hers now, not yours. Just because you gave it to her and it's kind of family property has no bearing at all. Now, assuming that she's willed everything to her husband, if she dies, well, that property is now his. It's no longer owned by your blood family at all, and that might be important to you. So we really do need to think this stuff through, but it is possible to plan in some flexibility into your arrangements so that if circumstances change, then your arrangements can change. So you might consider, for example, putting that property in a discretionary trust. Now, in such trusts, nobody has got the absolute right to own the property. So your daughter would be a potential beneficiary, not an absolute one. And that means that the property would be safe in the event of a divorce. If you've got more than one child, or maybe you've got grandchildren, maybe even nephews and nieces that you care about and want to possibly look after, well, you could write the trust in such a way that any of them could potentially benefit from the property at the discretion, the clue's in the name there, of the trustees. It's a discretionary trust. So, if you do that, maybe one of your grandchildren is going to university and you could decide, because you'll also be a trustee as well as the settler setting up the trust, you could decide that you will direct the rent from an investment property inside the trust to your student grandchild for 3 years to support them while they're studying. Once they graduate, you could say, well, maybe we'll redirect that rent to another family who needs it at that time, or maybe even let them live in the property for a while if they need that. The downside to such flexibility, particularly when it comes to trusts, is that discretionary trusts have a pretty punitive tax regime attached to them, so that's going to need to be a factor in your planning. Really don't need to go into different tax rates and all that stuff here for different kinds of income or gains. It will just muddy the waters. We're talking about planning, okay? I'll come back to the most salient point a little bit later on, I think. Now, as depressing as it sounds, you are going to need to think through some worst-case scenarios around your planning goals. And in light of that, you might just need to decide whether you want to put some structures in place which will be flexible enough to cope with changing circumstances. Really important that you try to think through what might happen and not just think in terms of what you want to happen today. Okay, second thing we need to do is to think about our property. Okay, now thanks to this podcast and to the very early days link with Rob and Rob of the Property Podcast and the Property Hub, I get loads of clients coming to me with significant wealth in property, and that's fine, of course. Property is just one of many asset classes, and it's got unique, I was going to say properties. Property's got unique properties, yeah, and many benefits, of course, but property can be difficult to plan around, particularly if it makes up the vast majority of somebody's wealth. And the reason for that is simply its illiquidity. Now, this is less of an issue for buy-to-let property as it is for residential property. If your home, the house you live in, represents the lion's share of the value of your estate, and it turns out you've got an inheritance tax issue, or you want to do something fancy with your planning, then actually your options might be significantly limited because you just don't have the liquid cash to plan with. It's all in your house. If you own a property jointly with your partner, you could maybe consider severing a joint tenancy and instead owning it as tenants in common, where essentially you own half each, or a different weighting each if you want to do it that way. That gives you somewhat more flexibility as what you can do with your half of the property value, but there may also be implications for your partner if you die first, so you need to be careful with that. Now, I mentioned the residence nil rate band last week, and that's an extra inheritance tax-free amount that you could leave as long as your beneficiaries get your primary residence. You have to leave it not just to your beneficiaries, to your direct descendants. Let's be clear there. Now, that might be jeopardized if you decided, for example, to leave your half of the property that you now own because you've severed the joint tenancy. If you leave it in a discretionary trust, you might not actually get the benefit of the residence nil rate band, all right? When planning, though, start with your property. It's usually your biggest asset, but be aware that property can be a limiting factor when it comes to estate and legacy planning. Next, we need to think about liquid wealth. After property has been dealt with, consider your other assets. Are you going to make some kind of specific or pecuniary bequests to your beneficiaries? That's items or money. Are there heirlooms or even a specific shareholding that you might want to pass down? If so, that's fairly simple. You can either give those things while you're alive, or you can make a specific instruction in your will. Remember, gifts made while you're alive are potentially chargeable to inheritance tax if you die within 7 years of making the gift. Calculations are all fairly simple for most of us. When you die, your executors will need to look back 7 years to ascertain the value of any gifts made, which are not covered by the various exemptions. Those gifts will use up the nil rate bands first, leaving more of your estate on death then to be taxed. If you die between 4 and 7 years after making a gift, the amount of tax is reduced on a sliding scale, which helps. But again, you really must think through the implications of making lifetime gifts, not just when you make them, but the impact on your wider estate if you die too soon after. Now, you can take out a simple life insurance policy called a gift inter vivos policy, which lasts for 7 years and is designed to pay the tax on that sliding scale on any gifts you make should you die within 7 years. Not enough of these are taken out, in my opinion, but that's probably because life insurance isn't cheap, because very often those making lifetime gifts are older and hence higher risk, probably with medical conditions. But if you do take one out, make sure it's written in trust to keep the proceeds away from the taxman. Now, probably your plans will be fairly simple. Divide everything equally between my 3 kids, say. But if you've got a child perhaps with additional needs who will need looking after when you're gone, you might need to provide for them by putting money into a trust that can be used for their upkeep. Doing so sometimes can help with benefits that they may be receiving because it keeps the money out of their personal ownership, if you like. They may not be able to personally own assets because they don't have the mental capacity to do so. So a trust can be useful there. Or maybe you own a property and you would want them to be able to live in that property for the rest of their life, and you would provide money that they can upkeep the property. But when they're gone, maybe your property can be sold and left the proceeds can be left to other descendants. Well, if you think that through, Legacy planning can sometimes be the process of decades. In that example, you could die with a 40-year-old child, in inverted commas, who might need care for another 30 or 40 years. And by the time they die, your grandchildren will probably be in their 50s or 60s. So really is a long-term thought process. But you know what? Maybe there's nothing like that going on, and you simply want to leave a legacy where you make a bit of a dent in the universe so that people will remember your name. Well, that's why people endow educational awards or sports club prizes, or libraries or theatres have got their name on. And if you like that idea, you're definitely going to need to plan for that ahead of time and think about which assets might be used for that purpose. Maybe you ring fence some money and say that money goes to the cricket club for the upkeep of their pavilion, and I'd like them to put a plaque up with my name on or something. So think it through. It really is quite a process to try to think it all through and hold all the threads together, and then to try and think longer term. What are the implications of what I'm proposing to do? Fourth thing to do is to keep it simple. Yeah, that again, and keep good records. I'm going to keep repeating my mantra to keep it simple. Just because you can use trusts to make things happen doesn't mean that you should, right? In all your estate planning, please, please, please err towards simplicity. I'm sure if you heard that in the background, that was a very loud motorbike going past. So if you're thinking about leaving a property in trust for your kids, ask yourself, why don't you just give it to them now? Right? Not the house you live in. That generally doesn't work. But if you've got a rental property, or you've inherited a property, or that you're not using, you might just say, well, actually, I'll just give it to them now. Or sell it and give them the money. Maybe that would be more useful. Rather than setting up some fancy mechanism to provide help for your grandkids at university, why don't you just set up a regular gift to them by standing order from your bank account to theirs? Simple is always best. It's best because it's usually cheaper. You ain't got to pay a lawyer to write a trust, and it's less likely to come with punitive tax implications. But whatever you do, whatever you end up deciding, please keep good records. And this is especially true for gifts. All you have to do is keep a simple log of any gifts you make, whether to individuals or charities. And all you need is to show the date, how much, and who to, right? That will be invaluable when your executors come, to submit their returns to the revenue when they're executing your estate. There's going to be no trawling through bank accounts or any of that. Just keep the log with your will and keep it up to date. How much of a blessing will that be to the people who have to sort your affairs out one day? If you do set up trusts or other mechanisms, then obviously make sure the documents are kept centrally somewhere that they can be got at easily by those who need them. Make sure that there are copies, proper certified copies by a solicitor, not just photocopies. Make sure they're held off-site in case a house burns down or something. God forbid. Keeping good records is always a good plan, and yet it's something so many of us just don't do well enough. I know why. There's more interesting things to do than keep records of gifts made, but super useful. And finally, folks, while I spend lots of time telling you that you can do almost everything to do with your personal finances yourself without professional help, this is one area where you really, really will benefit from paying some money to a competent solicitor. They will help you think through all your options because they know how the system works. Remember always to start from the point of your wishes. That's where we start from. Then they will help you draft the relevant structures, wills and trusts and things like that to get it all done. They will carry PI insurance, professional indemnity insurance, so that if anything goes wrong, there is recourse for you or your executors and your beneficiaries to claim. If you do set up trusts, then there's going to be tax returns to do, investment reviews to complete, and a whole load of more stuff besides. Now, a good lawyer will let you know exactly what the practical implications will be of whatever it is you're thinking about doing. You will weigh up those implications, and maybe you'll opt to choose, a simpler route instead. Most people do. But please, don't try to DIY your estate planning unless it's really simple. In fact, even if it is really simple, get a proper professional will written. Farewill.com, remember, FAREWILL.com. Use the code MEANINGFUL20 to get 20% off. And if you're considering anything more fancy than that, go and see a local solicitor. I tell you, it will pay for itself many, many times over if you're building trusts or foundations or whatever. Definitely seek professional advice. Over the past 20-odd years of doing my job, I've talked more people out of setting trusts than I have set up for people. And usually that's because people think they might be able to get around inheritance tax or whatever. But let's be clear, the HMRC can afford better lawyers than you. You really don't want to get into a fight with them. And there is now a set of rules called the General Anti-Avoidance Rules, which are kind of like a catch-all set of rules to stop people taking advantage of perceived loopholes and coming up with structures to try and get around the tax rules. Now, most of you listening to this won't ever need to engage in super complex estate planning. Those of you who can, or who do want to do that, can afford to get it done properly with good advice and having all the implications thought through for you. But in it all, remember, I'll say it again, your needs come first. Planning for your eventual demise comes way down the list of priorities compared with, for example, planning your next holiday or a big blowout birthday for the grandkids or whatever, right? Your needs come first. Enjoy life in the now. And certainly don't plan for what happens when you're no longer around at the expense of enjoying today. Promise? Okay, a couple of reviews. This is called The Path to a Meaningful Life by Concub1, who says, listen to this podcast, ! Pete puts finance into simple terms you can understand and then maps out the actions you need to take for success. I listen to a multitude of US shows on finance, and it's refreshing to have a UK-based resource that emphasizes the simple steps you need to be successful with money and ultimately lead the type of life you want. Keep up the great work. Pete, thank you very much. I get a lot of comments about it being UK-based. Still not enough of us doing it. There are some great UK-based podcasts, though. Inspirational, says HD86. I've been listening to Pete for 2 years now, and whilst I considered myself good with money, in reality I was passive. Pete made me wake up and take far more control. I now have an emergency fund. I'm making higher pension contributions, automated savings into various ISAs, and also rid myself of bad debt and a fuel-guzzling convertible that wasn't serving me. Between Pete and also the two Robs of property podcast fame, the future is far more secure, open to choices and opportunity than would otherwise have been the case. Thank you, Pete. Love that. Thank you, Concub1 and HD86 for those reviews. If you want to help me out and leave a review, please do. meaningfulmoney.tv/iTunes. If you're sort of an Apple Podcasts person, but wherever you're listening to this, if you can leave me a review or just a star rating, please do that. It helps keep the show near the top of the rankings, which means that more people can find me and subscribe. Don't forget, Meaningful Academy is open for phases 1 and 2. That's financial foundations and build wealth. If you're particularly interested in phase 3, which is all about retirement planning and isn't out yet, then you can head to meaningfulacademy.com, click to register your interest, and we'll keep you posted. Now, every Friday, except for the last few weeks while I've been getting better, but every Friday normally, under normal circumstances, I send out the Meaningful Digest email, which is a summary of what's been going on here at Meaningful Money throughout the week, plus useful links, my musings about whatever it is that I'm thinking about. And thousands of people get that every Friday. So if you want to do that, head to Meaningful Money website, which is at meaningfulmoney.tv. A couple of seconds after you've been on there, a little drop down comes at the top, and you've got the option to join the mailing list there. Okay, folks, next time we're going to be talking about long-term care, which is a subject on the minds of many folks that are in retirement. We're going to be looking at what you can do to prepare financially for it, some of the mechanisms you can use to provide for it. Long-term care is next week. And that's it, folks, for this session of the podcast. Hope it was helpful. Any questions or comments, go to meaningfulmoney.tv/RP10 for Retirement Planning Episode 10. Hope you enjoyed it, folks. Thank you so much for listening. Appreciate your company once again. I'll talk to you next time. Cheers.